8 stock earnings in one video. You'll see on screen now the stocks I'm covering. Don't miss these opportunities. Not only will I be covering the earnings, I will also be giving my valuations on every single stock that we are covering today. I will also be showing my buys and sells for this week, so you'll be able to see what my portfolio is doing. Without any more, let's get into it. Very mixed week for the market this week. Big earnings came out and you can see which have been hit and which haven't. Apple down 5%, Amazon down 6.8%, which is really unfortunate for me because it is my second largest position. But we see Meta absolutely flying this week, absolutely flying. Healthcare continues to be in decline, and Microsoft doing well. They were doing better yesterday, but today they've pulled back a little bit. Other than that, we see quite a mixed bag. My portfolio for the week is actually up £87, but the rate of return somehow is negative, minus 0.3. Not sure if trading 2-on-2 is glitching there, but it was up majorly at one point yesterday, up 2.5 grand, and that was because of hims and hers. You could see they did a crazy spike here. When that happened, I was actively managing the portfolio at the time. May have done something. We have to see in a minute. Moving into the first stock, Mastercard. Now, this is a stock that I always say is the poster boy for the perfect fundamentals. Everyone knows what Mastercard does. They are basically the rails in which the payment systems on your card work, and they're seen as an old company. They're actually a very good tech company. Their PE ratio is quite high at the minute, sitting at 37 with a 32 next 12 months PE ratio. Their free cash flow yield, however, is pretty reasonable with 3.24% free cash flow yield. Now, getting straight into their earnings, their revenue was up 14.5% trailing 12 months. Really good growth from Mastercard, and this is exactly what we want to see, with their total Mastercards up 6.5% year over year. Strong demand still for Mastercard. People moving away from cash and using card more. That is the underlying thesis for both Mastercard and Visa. Such a strong bull thesis. Now, in terms of their earnings per share, they were up 13.38% on a trailing 12 months basis. But when it comes to free cash flow is where they really shine. Up 44.8% trailing 12 months in their free cash flow. Absolutely insane growth. So glad to have this as one of my holdings. And if you take that on a stock-based compensation adjusted free cash flow per share basis, so we've taken stock-based compensation out and we're now looking at the free cash flow per share, it's even larger at a 49% year-over-year increase. Now, moving on to what was said in the earnings, they really reported a strong first quarter. The gross dollar volume, which is basically the amount of dollars used to pay on their cards globally, rose by 9%. This shows really strong continued demand. The US had 7% growth, internationally 10%, which is great to see. It's great to see that there is still consumer demand, shows a healthy economy, and Mastercard obviously benefits that as the toll booth to pretty much all card payments. There was fears for Mastercard's bull thesis in the fact that a few large retailers said that they were going to be taking crypto as payment, and here Mastercard address how they are integrating crypto payments through card issuance partnerships with Kraken and a couple other companies that I've never heard of, enabling stablecoin settlement for merchants. So that is really cool. They're on top of this and it's not really a worry for me. Now onto the DCF for Mastercard. So I've inputted a free cash flow per share growth rate of 15%. This is much lower than obviously what they've done this year. I think they'll continue to just pump out 15% free cash flow per share. They historically, I think, have grown at a free cash flow per share growth rate over the 5-year of 18% and over the 10-year of 19%. So I'm picking a lower amount here at 15, and then I've picked a free cash flow yield of 3.2, which is just below what they're currently trading at, and it gives me a return from today's price of 15.31%. And an entry price, if you want 15% return, of $568.12. Now, this is obviously in buying range for me. I would buy more, but I see other opportunities in the market at the moment. I also have quite a large Mastercard position already. So moving on, we have Visa. Now this is a company that I had in my portfolio last week. I'll cover exactly what happened to Visa and why it's no longer in my portfolio in a second. But essentially, Visa has been hit and is actually trading lower after earnings. They had a reasonable earnings, but yes, they've been hit and they're still 8%, still up 8% year to date. They've just had a short little drop after earnings. They're sitting at a 33p ratio, lower than Mastercard's, and they have a free cash flow yield of 3.34%. Their revenue grew a little bit slower than Mastercard's at 11.38%. And if we have a look at their total Visa cards, they grew them by about 6.6%. Now, the important thing, the free cash flow continues trending upwards. Nothing like Mastercard's though, only up 16.47% year over year on a trailing 12-month basis. Over the 2 years now, we're only looking at 8.8%. This is much slower than Mastercard, and this is probably because Mastercard has a much stronger European uptake and they're just growing better in Europe. Now, if we look at the stock-based compensation adjusted free cash flow per share, they have a 1 year of 21.51%. Now, this is great still, really good to see from Visa. Over the 2 years, not so amazing, but still 5 years they're averaging above that solid 15% that we all need to double our stock portfolio every 5 years. If you want to know why 15% doubles your stock portfolio every 5 years, I have a video for that, check it out. So overall, not too bad from Visa. When we look at the earnings transcript, we do have the reassurance that there is strong consumer spending across all brands and categories. Now Visa is much more heavily reliant on the US. They control the dominant market share in the US in terms of cards. Now for them, payments volume only grew 8%, which goes to show that Mastercard really is doing better outside of the US. Moving on to the DCF calculations for Visa. For Visa, I've estimated a 14% free cash flow per share growth rate from now on and a free cash flow yield of 3.4%. This is slightly higher than the current free cash flow yield of 3.34%. I've done this because I believe that Visa's growth is slowing mildly. Not too much though. Now this gives a return from today's price of 13.6% with a 2030 projected price of $645. For me, this is one that I am not buying. In fact, I actually sold my position in Visa before earnings, so before the drop, at a fill price of $358, which is a little bit higher than what we're currently trading at. I then put all the money, £1,402, into Alphabet. I've covered in a video why I think Alphabet is a really good bet. They are highly undervalued at the current price, I believe. Go watch that if you want to see why. Moving on, we have Booking Holdings. This is another one in my portfolio, and they are trading lower, a little bit lower after they've reported earnings. They're still up 11% year to date. They trade at quite a high PE ratio currently of 38, but next year's PE is 23 with a free cash flow yield of 5.15%. They usually trade at a free cash flow yield of about 5.3 to 5%. So this is not unusual for Booking.com. But it's been quite a strong quarter for Booking.com with their trailing 12-month revenue up 11% year over year. Their room nights sold continue to be strong, up 9% almost year over year. Really strong room nights sold. And overall, Booking for me is just a quality company. They have returned so much capital to the shareholder in the form of buybacks. You can see here their shares outstanding consistently dropping. I mean, year over year, we're looking at basically 5% drop in the amount of shares. That's money that is being returned directly to the shareholder. But not only that, they do pay dividends as well, paying $1.2 billion out in dividends. Now, looking at their free cash flow growth, they have had pretty great free cash flow growth, up 23% on the year. Really fast growth, really strong from them. On the 10-year, up 12.66%. Now, this strong free cash flow growth year over year doesn't even take into account the share buybacks, which obviously lower the amount of shares and increase the amount of free cash flow per share. And we see a 30% increase year over year in free cash flow per share for this company. Booking.com is one of those companies that you don't think is a compounder, and it just turns out to be printing money and returning it straight to the shareholder. When we look at the earnings transcript, a lot of the revenue was aided by favorable foreign exchange impact, which gave them about 4 percentage points of the 16 that they rose year over year when looking at the quarterly earnings. They also had some pretty crazy EPS growth of 32% year over year. Now, when we look at their outlook, their room night growth is expected to be quite moderate for Q3, being between 3.5% and 5.5%. This has affected my predictions for Booking.com. When I use a discounted free cash flow model to estimate their future returns, I used 14% free cash flow per share growth, which is much slower than what they've been doing at the minute. And that is because their outlook is a little slower than a lot of people would like it to be. It's still outstanding, but it's a little slower. I've put the free cash flow yield at 5.3%, and we get a 13.85% return from here, with a price target in 2030 of 10.36 thousand. Moving on to Meta Platforms, they had an absolutely outstanding earnings. They're up 11% on the day, which is pretty outstanding. I mean, I haven't actually been checking up on them, but that is crazy performance from Meta. Meta is my smallest holding, if you don't include my little watcher positions that I have. I only have about 1,500 in there, I think, and it's growing very quickly. Now, Meta sits at a 27 price to earnings ratio and a 2.57 free cash flow yield. We see their revenue growth of about 20% year over year. That is crazy for a company to see a 20% revenue growth year over year when you're pulling in over 178 billion per year. They are up 25% year to date now. I bought in around here. This is around tariff time, and they've done great for me so far. They are consistently growing their family active people. I mean, they make up, near half of the world now with how many people are using their apps, and they're still growing at a rate of 6.42% yearly. That is just insane. They are basically capturing, the size of Brazil, hundreds of millions of people. That's an entire country like the size of Brazil that they've captured year over year here. Now, when we look at their EPS growth is crazy at 41% year over year. Insane EPS growth. Now, I'd like to mention their free cash flow is dropping, in fact, and this is because of their huge investment in CapEx. We can see over here in the expenses column, if we just get rid of that, we can see CapEx is spiking drastically, and we know why this is happening. There is heavy investments that continue into AI, with a focus on building personal super intelligence accessible to all users. We know that Mark Zuckerberg is going on a crazy one, and he's trying to hire all of the best AI engineers, super whizzes, to create a super intelligence labs, which will integrate the leading AI talent. And he's paying a lot for this. And not only is he paying a lot for this, but he is paying a lot for their computer infrastructure, which is rapidly expanding. Prometheus and Hyperion are both clusters that they have in the pipeline, and they have multiple more in development. Hyperion is designed to scale up to 5 gigawatts. That will be, I'm pretty sure, the largest we have seen. Now, what is crazy about Meta is that pretty much all of their efficiencies and earnings growth is coming from their AI. So their AI ad system is increasing conversion rates, about 5% higher conversions on Instagram and 3% on Facebook. Them capturing a higher conversion rate means that they can charge more for the sale of their advertisements on Instagram and Facebook. It also means that the companies paying for advertising are way more satisfied with the product. Why wouldn't you go to Facebook, or why wouldn't you go to Meta to advertise your product when they're giving you such high conversion rates? Now, they're also using LLMs to drive improvements when it comes to finding original content. I know for a fact that this is happening because my girlfriend has seen crazy growth on Instagram recently. She's a little Instagram content creator and it's just popping off. I think this is something that TikTok mastered a while ago, hence their huge growth. But now that Meta Platforms has found the same thing where they could stop pushing reposted, stop pushing brain rot content, and actually push some original stuff, is really good for Meta because they have such a large user base already. So they can push that out and people will be very satisfied with the product. Moving on, Reality Labs is still increasing at 5% revenue. There's been strong growth in the Ray-Ban Meta smart glasses despite the lower Quest sales. So that's the virtual reality is the Quest. The Ray-Ban Meta is like the augmented reality. And I actually think they look quite good, those Ray-Ban Meta smart glasses. I think it will be a way for people to instantly access AI in the future. Moving on to what I think of Meta in terms of the future. I think that Meta is going to continue to blow us out the park. I've picked an EPS growth rate of 21% for the next 5 years. I think there's so much more efficiency to come with Meta. I think the investments they're making now into AI will pay off in the future. And with this, I've given them an appropriate EPS multiple of 25, which is below what they currently trade at. Now, this has given me an estimated 18% return. Wow, almost 19% return from today's price, with an entry price for a 15% return being at $890. So I believe it's undervalued at the minute. It does offer major opportunity. I think that the safer bet for me is still Google, especially as they're trading at such a low PE ratio, but Meta is a great investment still, and there's no surprise to me that it is flying up in price. If we have a look at their price, up 11% today alone. Crazy from Meta. Moving on, we have FICO. This is a stock that I bought into and did very well to exit very quickly. I bought into it on the dip here and I then sold out of it when it climbed a little bit. I might have lost about 20 quid. I can't actually remember. All I know is that I basically broke even on the position, and this fell due to the FHFA, which is essentially the Federal Housing Committee kind of people. They decide on housing. FICO offers the FICO score, which is a credit score, a dominant credit score in the US that you need when you are taking out a mortgage or taking out any kind of loan. It basically offers credit and mortgage lenders security into, so that they don't lose money when they're lending money out to you. Now, the FICO score for years has had a complete monopoly over the scoring system in the US, and this was attacked recently by the FHFA. Bill Pulte essentially opened the market to another type of score, the Vantage score, in order to stop FICO from having such pricing power, and the pricing power is what gave them their incredible growth. Now, it's dropped more after earnings. They still, in my opinion, had stellar earnings, with the revenue up 16% year over year and the free cash flow up 40% year over year. If you look at the stock-based compensation, adjusted free cash flow per share, it's up 50% year over year. That is crazy growth, and that is all from the pricing power. This is basically, they raised the prices too quickly on their FICO score. It attracted the government attention, and that is why it's dropping so much. They trade at a PE ratio of about 50 still, so they're still very expensive, but they are still growing very quickly. I'm hesitant to enter the stock again, just because I believe that they will not want to attract much attention after the government's had a look into what they're doing, and they'll want to probably raise prices a lot slower from now on. They did, however, say something very interesting in their earnings transcript when talking about the fact that there is no longer a set standard score, the FICO score, for mortgage credit. There's now competition with the Vantage score. FICO has said in their earnings transcript, lender choice encourages mortgage participants to shop for the most lax score, which drives unavoidable gaming and adverse selection for all risk holders. It creates a race to the bottom by incentivizing score providers to weaken their credit decision criteria to score more consumers and one more business with their score. this will lead to increased costs for consumers in the long run. Now, what they're saying here essentially is that when you have multiple credit score providers, the credit score providers will want to give the consumers the best credit score they can in order to basically have them as a customer. This will lead to an increase in defaults on the debt, which then makes banks or lenders increase the interest rates on their debt in order to cover for increase in defaults. This is essentially what they're getting at. Now, I know this is quite complex for this video, so I'm not going to go any further into FICO at this moment in time. When we look at FICO's valuation, I do think FICO is rapidly approaching a point where it is a buyable stock again. When I give it a free cash flow per share growth rate of 17%, far below what it's been doing at the minute, and which is what I think is about right from now on. I think they will really slow down in terms of their price raises, like I said a minute ago, and I give them a free cash flow yield of 2.5%, which is higher than currently, so that's a bit of a devaluation. The return from today's price is about 12.69%. Now, I'm going to be waiting, if I do ever buy into FICO, for an entry price of 1,237, currently sitting at 1,370. So I do believe that there is more room to drop in FICO at the moment. It's very highly valued, although it is interesting, and I will be tracking this one closely. Moving on, we have a stock requested by one of my friends, Duolingo. Now, Duolingo shares have dropped actually recently quite a bit from their high of 520 down to their current price of about 335. They're trading at a crazy price to earnings ratio of 156. So let's just bear in mind that at the current amount of earnings, it would take 156 years for them to pay back your original investment. Now, obviously, we can't just look in the PE ratio in isolation because their earnings update year after year, especially this company is growing very quickly. Next year, they should have a price to earnings of 87 based on analyst estimates. They have a free cash flow yield of 1.9%. And if we have a look at their revenue trailing 12 months, their revenue trailing 12 months is growing at a year over year rate of 40%. Over the 2 years, 41, and over the 5 years, even quicker. So this is a decelerating growth rate in revenue, but this happens to every company, especially young companies. What impresses me about Duolingo is how quickly they grow their daily active users at year over year 50%. Now, this is really good to see. If you imagine you saw like Visa or Mastercard growing their daily active card members at 50%, it would be crazy. This is why they trade at such a high PE ratio. Now, when you have a look at their paid subscribers, that's gone up 40% year over year as well. Monthly active users up 33%. All things that are great to see. Their paid subscriber penetration rate, this is essentially what percentage of their users are paid, and we're looking at 8.9%. It is ticking up a lot slower than originally in 2021. Obviously, it's plateaued a bit, but literally any tiny increase in this amount is really beneficial for the margins on the company. They do make money from their free tiers, from the adverts, but let's get into their free cash flow growth. Their free cash flow growth year over year, 52%, absolutely crazy to see. They do actually have quite a lot of stock-based compensation, making up just under half of their free cash flow. This means that their stock-based compensation adjusted free cash flow per share is a lot lower than their free cash flow per share. And Duolingo is a company that's growing fast. The dip that's happened is because investors did believe that they would have a faster daily active user growth. So that's why they have dipped quite a bit. They wanted a little bit faster of a growth rate, and that is understandable because when I go to look at my valuation for Duolingo, I base it off earnings. If they have an EPS growth rate of 40%, which is very high, especially for 5 years in a row, 40%. 5-year projection, but I could be persuaded otherwise. I'm going to do a bit more research into Duolingo. I think it would have to be trading at an EPS growth rate of 50% for the next 5 years in order for it to be an attractive buy at 17% return from today's price, an entry price of 379. Obviously, if we had it trading at a PE ratio of something like 40, which is what Microsoft is currently trading at, you're looking at 12% there. And then if you look at 40 growth rate, you're only getting 5% return there. So with Duolingo, I'm not going to be buying into it just yet. I might do some more research, come back to it in next week or the week after in a video. We'll see. Moving on to S&P Global. S&P Global is a company that I hold in my portfolio. Most of these companies are companies that I hold in my portfolio, but they are actually trading higher after the company reported better than expected Q2 financial results, and it raised its guidance and adjusted EPS guidance above the estimates. Now, they are trading at quite a high PE ratio of 43, but when it comes to free cash flow, they're not trading at too expensive a price, 3.3% free cash flow yield. Now, their revenue was up year over year at about 13%. This is really good to see for a company as old and as monopolistic as S&P Global. Moving on to their free cash flow, you can see their free cash flow growth of a crazy 41% year over year. Now, S&P Global's free cash flow tends to come in spikes and waves, but this is really good to see. When you're looking at the stock-based compensation adjusted free cash flow, you're looking at 42%. As you can see over the 5-year, much slower, but S&P Global is one that I can always rely on. If you don't know what S&P Global does, they give out credit ratings, and they also own indexes like the S&P 500. They also give out data analytics dating back many, many years in terms of market analytics. S&P Global would benefit largely from a drop in interest rates because more people would take out large debt amounts. More companies would take out large debt amounts, and those companies would have to be debt rated by S&P Global or Moody's in that duopoly. So I've estimated for S&P Global a free cash flow per share growth rate of 12% from here and a free cash flow yield of 3%. Now I've lowered the free cash flow yield here to 3%, which is actually obviously a positive thing for S&P Global because I do believe over the next 5 years interest rates will probably come down, and this will lead to an increase in price for S&P Global. And this offers a 14.3% return from here. Personally, I wouldn't buy into it right now. I do have quite a low position, so I'm quite happy with the position at the minute. Moving on to our last company, we have Microsoft. Microsoft reported a crazy good earnings, guys. Better than expected. But the thing is with Microsoft is they trade at an expensive PE ratio of about 40 currently, trailing and 35 over the next 12 months, and a free cash flow yield of only 1.8%. Still, they absolutely blew us out the park. Their revenue growth was 15% for a company this large. That is really, really good. Now, what blew most people away was the Microsoft Cloud or Azure annual revenue exceeded 75 billion, which is 34% increase. This is the best of the hyperscaler cloud giants. So it's the best of Amazon, it's the best of Google, and obviously Microsoft. So they are gaining market share, and this is why people are bidding the price up for Microsoft. Now, when it comes to free cash flow, they were actually down. Obviously, this is the same reason as Meta with their capital expenditures going through the roof in order to fund. I mean, look at that, absolutely through the roof. 64 billion in capex in 1 quarter. And this makes sense because they're investing heavily into AI, and hopefully this will pay off. It's paying off at the minute with their cloud growth and their cloud revenue. So I think we'll see it continue to pay off. In terms of the calculations for their growth and whether I think they're undervalued or not, I've given Microsoft an EPS growth rate of 17% over the next 5 years, which I think is very good and very high, 17%. I've given them an appropriate earnings per share multiple or PE ratio of 32. This only gives me a return of 12.8% from the current prices here. So I don't think that Microsoft is a buy right now. However, I could be completely wrong. I know a lot of people are just buying big tech at the minute, and it's working out very, very well for them. So what did I do yesterday? Yesterday, I made a trade. I actually sold Hims and Hers, only £530 worth of it, and I bought into Alphabet. Now, why did I sell Hims and Hers? The company just became such a large percentage of my portfolio, taking over 21% at the time. It traded up to $70, which is where I sold it at Actually, yeah, $70.1 is where I sold it, taking of the 530 a £251 gain. Well, basically it is all gains for me, because when we look at my portfolio, hims and hers, let's have a look quickly at the month. You can see here it flew up yesterday. It won't even show you on the month. If I click on the week, it flew up to 70 yesterday. I sold it at 70. It still won't even show on the week. So it's such a brief period of time. It was at 70, sold 500, put it into Google. I think it's a really good bet, Google. I wanted more money in it. And yeah, I just extracted some equity from hims and hers because it was flying on the, on the day. I think yesterday it was up like 14%. On the week, on the month, it's up 30% right now. Obviously, I'm going to keep hims and hers as my top position. They report earnings on Monday. I will cover Amazon in its own video. It's dropped quite a lot after earnings, which is a shame. And this is just due to the fact that their cloud growth is slower than Microsoft and Google's. But a lot of people aren't taking into consideration the fact that Amazon is already a larger in terms of revenue and customers using it, and the law of large numbers obviously prohibits you from growing infinitely fast. That is it for this video, guys. Thank you, and I'll see you in the next one.
I'm hopping out Ferrari. My house is 3 stories. I'm still independent cause Jive couldn't afford me. The meetings were boring. For real, I was snoring. The VP was fine, yeah, she treated me